In this video, we're doing a four-way rev share comparison between EXP Realty, LPT Realty, Real Broker, and Epique Realty. I'm going to break down in detail the specifics about each brokerage, what they have to offer in terms of rev share, how large you can grow your organization, how much you can make per agent, and ultimately how much you can earn in residual income at each. At the very end, I'm going to do a 10-year earnings comparison across all four brokerages so you have a very realistic idea long-term of how much you can make at each of these brokerages. I think you may be as shocked at the results as I was. If you're thinking about joining one of these brokerages and rev share is one of the reasons you're looking at joining, you need to watch this video. Guys, I'm excited to jump into this with you and we're getting after it right now. All right, everybody, welcome back. Thanks for tuning in. My name is Mark Ames with Elevated Agents, and I am very excited for this video because today we're going to be breaking down the four most popular real estate brokerages that offer revenue share as a benefit of the brokerage. And so we're going to be looking at EXP Realty, Real Broker, Epique Realty, and LPT Realty to see what the differences are. We're going to go through each model. We're going to look in detail at what they offer, how many tiers you get access to, how many qualifiers you need, how much you can make per agent, and then at the very end, we're going to do a 10-year earnings comparison across all four so you have a very realistic picture of what the long-term potential is for growing a rev share organization at each one of these brokerages and which one might be right for you. Honestly, when we got to the end, the results kind of shocked me. I think they'll probably be a little shocking to you as well. So stick with me through the end so you can see the actual apples-to-apples comparison across the board for all four of these. First thing we want to jump into, though, is what is revenue share? If it's something that you're not familiar with, revenue share is where a brokerage shares its earnings with its agents for helping to grow the company. I like to think of it as performance-based marketing. So instead of a real estate brokerage having to go out and spend a lot of its own capital on TV commercials and radio ads and billboards and flyers and in-person marketing events, they can take the real estate agents that are already at their brokerage and say, hey, if you guys want to go out and do the marketing for us, tell other agents in the industry what you like about our brokerage, how it's helping your business. If you can get that agent to join our brokerage and they name you as their sponsor, when they close a real estate transaction up to their cap, a portion of the revenue that comes to us, we're going to send back to you as a performance-based marketing award for helping to bring that agent on and helping us as a brokerage grow. That's what revenue share is. Now, each one of the models that we're going to talk about today accomplish that in a very different way. These models on their surface are all fairly different. What we're going to see today is how much difference does that really make? So there's three sides of real estate rev share that we're going to explore today. There's the rev share per partner, and that's really a function of how much of the revenue the brokerage is willing to put into the revenue share pool, and then how they break that percentage up across the various tiers. So the way that this works, again, is you go out and you find an agent that wants to join your brokerage. They name you as their sponsor, but then they can go out and do the exact same thing. That agent that you brought on directly is in your tier one. But if they go out and they bring an agent on who joins and names them as their sponsor, that's now your tier two. And so most of these organizations have multi-tiers that you can tap into. And so that's really important. So we're going to look at the rev share per partner. We're going to look at the size of the organization. This is going to be a function of how many tiers you have available to you, as well as how many frontline qualifiers you have, and a few other factors we're going to discuss as well. And the last thing that we want to touch on, which is really important, is the overall growth potential. Is the brokerage that you're aligned with, do they have the potential to grow to the level that would be required for you to actually earn the revenue share that you're trying to earn? So those are the three parts that we're going to look at today. The first part that we're going to look at is the revenue share per partner. And so what we're going to do is go brokerage by brokerage. We're going to look at what each one has to offer and how they structure their rev share program. All right, guys, I want to start first with EXP Realty and take a look at their rev share model, because EXP is really the company that introduced revenue share to the real estate industry. Before then, it really wasn't a thing. There was profit sharing, but unfortunately, most of these brokerages weren't profitable. So there was no profit left over at the end of the year to share. So EXP came out with a slightly different model and said, hey, we're going to be a cloud-based brokerage. We're not going to have brick and mortar locations. You can work from anywhere, work from home. We're going to collaborate online. And then we're going to reward you for attracting agents and bringing them into the company. We're also going to give you an opportunity to earn equity in the company. So we'll give you rev share if you bring agents on and they sell real estate, and we'll give you stock in the company for selling real estate and for bringing agents on. So this was really revolutionary. Since then, this has kind of become now the standard model for a lot of brokerages that are coming out. But I want to start with EXP just to see how they structured it, and we'll see then how some of the other brokerages that have come out have done it slightly differently. This is EXP's model right here. So EXP has an 80-20 split. Every single agent at EXP is on the exact same comp plan. There are no options. It's 80-20, and you have a $16,000 cap. Now, the percentage of revenue share that's available currently is 50%, and this was a recent change. So up until about a month ago, EXP had something called a sustainable Rev Share buffer. And essentially that was kind of a secret algorithm that they had behind the scenes where every single month, the amount of Rev Share that was supposed to be given out, if it was too much for them to remain profitable, they had to decrease the amount of Rev Share they were paying out the agents. But the downside is no one really ever knew how much it was. Realistically, it was 50%. So they were never going to pay out more than 50% of their revenue in Rev Share, but they kind of had this algorithm that every single month had to be adjusted. And so as some other models started to come out and make things a little bit more transparent by just saying, hey, we're going to put 50% into the rev share pool, we're going to put 50% towards company profit. After a few years, EXP got on board and did the same thing. And so they are now at a 50% contribution of revenue back into the rev share pool. With a $16,000 cap, that's $8,000. So right off the bat, EXP per agent does have more rev share available than most of these other brokerages as a function of the fact that they have the highest cap. So 16,000 is the highest cap that we're going to look at. And so therefore 50% of that just happens to be more than anyone else. But again, there's no way to opt out of that. So every agent, regardless of whether or not they're participating in rev share, is still paying the $16,000 cap. Now they have 7 tiers, right? So that means you've got your tier 1, the people that you bring in, and then 6 levels below that. And a frontline qualifying agent, and now every brokerage has a different definition of what a frontline qualifying agent. For most of them, it's generally having to have a certain commission amount that has been brought to the company in a certain previous amount of time. So that may be $3,000 GCI over the last 6 months, or 1 core transaction over the last 6 to 12 months, whatever the case is. So in order to unlock all 7 of the levels at EXP, you need 30 plus frontline qualifying agents. And then you can see the percentages here that go to each tier. So that's EXP's model. Now we're going to move on to Real, because Real was the next brokerage that was really able to successfully kind of compete against EXP with a similar but different model. And so this is how Real has their structure. So it is a 85-15 split at Real Broker. You have a $12,000 cap. They also have something called a Rev Share participation fee, which is $175 per year. And then they have a Rev Share processing fee, which I think is like 1.2% of the Rev Share goes into the administrative costs of processing all that. I don't really see any issues there. That makes a lot of sense. The percentage of rev share that's available there, so their buffer is 60% of the revenue per month. So the way that this works is at Real Broker, if the amount of revenue share that they're supposed to pay out or that was earned is more than 60% of their revenue, they basically figure out the proportion of the rev share that you earned relative to the total amount that should get paid out. They're going to decrease that amount down to 60% of their revenue for that month, and then you'll get a prorated amount of revenue share, which is less than essentially what you earned, but they have to, again, make sure they stay profitable, and they've got that set at 60% of the revenue per month is how they break that down. They have a 5-tier system. So as opposed to the 7 tiers at EXP, they've got 5. We'll see how that makes a difference later. And then the number of frontline qualifying agents for each of their, to get all 5 of their tiers is 25 or more. You can see how they've got it broken down from $4,000 per agent per year to $3,200, $2,400, $1,600, and $800. So as you go down in tiers, you progressively get less and less of the revenue share for that tier. Now, Epique Realty, this is a newer brokerage that came out, but I have heard some people talking about it, that they also have a revenue share model as well. And theirs is probably the most different in terms of how they do it. They have an 85-15 split, just like Real Broker. They have a $15,000 cap, but the cap decreases by $1,000 per year for the first 5 years. So everyone starts at a $15,000 cap, and then if you stay there long enough, you can get down to a $10,000 cap. Similar to what we saw at EXP, they share 50% of the available revenue. And so that's going to be anywhere from $5,000 to $7,500. So again, at Epique, one of the things that's a little bit different is every single year over the course of 5 years, the revenue share that you're earning per agent in your downline is going to go down and is ultimately going to get cut in a third. So the very first year you bring someone in, they have a max potential of $7,500 per year that you could earn. And then by year 5, that goes down to $5,000. So again, there's a 1/3 decrease over time in the revenue share per agent as that cap goes down. They also have a 5-tier system similar to Real, and they do not have any requirement for frontline qualifiers. So essentially all 5 of your tiers right off the bat are open. And then they split it up 10% across the board. So again, the 50% across 5 tiers, 10% per tier. And lastly, we've got LPT's Rev Share. So LPT is a little bit different, and you'll see there's more columns on LPTs than any of the others. And that's because LPT has options about which comp plan you as the agent want to be a part of. So we have 2 comp plans. One of the comp plans that LPT has is very similar to some of the others, 80-20 split with a $15,000 cap, and that is the brokerage partner. That allows you to be a team leader. It has a higher stock multiplier. It allows you to actually collect the Rev Share that's generated in your downline, and there's some other benefits to it as well. And then there's also a flat fee model. So where you pay $500 per transaction with a $5,000 cap. So you do 10 transactions and you have capped. The biggest difference between those two, again, there's some differences in stock multipliers, but the biggest one is that when you're on that flat fee plan, you can still build a downline organization. But any of the money that gets generated, you basically forfeit in exchange for having that lower cap. So essentially, it's like coming in and saying, we're going to give you the equivalent of a $10,000 per year downline until you can build your own $10,000 plus per year downline. And at that point in time, you have the option to leave the flat fee and go to the brokerage partner. And now you're making up the difference in the Rev Share that you've been building while you were on the lower cap system. So because of that, LPT has the least amount of money going into the revenue share pool, even though they're still putting out the same 50% as Epique and the same 50% as EXP. Here, you're going to be looking at either $7,500 or $2,500 based on the comp plan that particular individual who did the real estate transaction was on. It's a 7-tier system, and the frontline qualifiers that are needed to unlock all 7 tiers is 20 or more. So this is the distribution of the Rev Share across the various tiers. So again, we have some 5-tier models, some 7-tier models, but here you can see what percentage gets paid out on each level at each of the different brokerages. You can see everyone has taken a very different approach. And so we should expect that the Rev Share that you can earn at each of these brokers should be substantially different based off of this. We're going to see if that's true or not. All right, so the next side of the revenue share that we're going to look at is the size of the organization that you can grow. And so what I've done is put together an example Rev Share organization so we can run some actual numbers to see what kind of revenue gets generated. And I wanted to make sure that we were using the same numbers for each brokerage. And so as you're looking at these numbers, you're probably thinking maybe I just pulled them out of thin air or made them up, and I didn't. Everything that we're going to go through is mathematically backed up, and this is a mathematical model that I put together to make sure there was no fudging of the numbers and that everything was as straightforward and consistent and realistic as possible. So in order to come up with this chart, I had to make 4 realistic assumptions to be able to build a consistent model. What were those 4 assumptions? So the first one is that in your first year, how you're growing your organization, because really, again, all you can control is how you grow your tier 1. Okay, the agents that you bring on directly is the biggest impact that you have. And so in your first year, you new at the brokerage, really, really excited about it. You attract 12 frontline qualifiers in year 1, 10 qualifiers in year 2, 8 in year 3, and then 6 every year after that from years 4 onward. Now, why do I have a decreasing number of agents that you're bringing on each year? It's because Rev Share models have a diminishing return over time, or a diminishing opportunity over time. The longer an organization has been in business, generally, the less opportunity there is to come in and build a large Rev Share organization. And it doesn't go away right away, but over time, the opportunity diminishes. And so I want to reflect that in here because a lot of the calculators that I see just assume you're going to recruit the same number of agents every year up and to the right forever. It doesn't work that way. The next assumption, this is a very important one. A lot of the calculators that you see and a lot of the people that you talk to about revenue share don't take attrition into account where they're talking about rev share organizations, right? Attrition happens. Agents will leave your brokerage every single year. If you've got agents in your downline this year, a certain percentage of those agents will not be in your downline next year. And that's just how it works, right? People get out of the business, people retire, people move to a different brokerage that offers more value to them at that particular point in time in their career. And so we need to take that into consideration. So the assumption that I have made is that every single year, 20% of the agents in every single tier of yours, 1 through 5 or 7, 20% of them are going to leave every single year. The next assumption, I'm only going to assume that about 20% of the agents that are in your downline are involved in agent attraction. And this is pretty realistic based on what we've seen. It may even be high, but we're going to say that 20% of the agents in your organization are actually out there trying to attract other agents. Now, of the 20% who are recruiting, on average, I have them attracting 6 agents in their first year, 5 agents in their second year, 4 agents in years 3 through 5, and only 3 agents per year in years 6 onward. Again, for the same reason that over time, the opportunity in a rev share organization does diminish, and the number of agents that you're likely to be able to attract each year will very likely go down over time. And so I want to reflect that realistically in this model. So where did all these numbers come from? Those are the assumptions I made, and this is how your tier 1 kind of broke down. So again, starting off in year 1, you have 12 frontline qualifiers. Awesome. But in the next year, you're only going to attract 10, and 2.5 of your agents from the first year left. Remember that 20%, they're gone. So now you have 20 in year 2. The next year, you attract 8 agents, but you lost 4, right? You lost 20% of the agents that were there the year before. That leaves you with 24. The next year, you add 6, you lost 5, you've got 25. The next year, you added 6 and you lost 5 again. So you're at 26. As you can see here, over those 10 years, in year 10, you still only have 29 frontline qualifying agents. However, if you were to add up all the agents that you added each year, you actually added 70 agents to your front line, but you only have 29 left. And that's the function of attrition. Agents do leave, and they don't just leave on tiers 2 through 5, they leave on tier 1 as well. There are some things that you can do as a sponsoring agent to help minimize attrition, but also a part of that is going to be on the brokerage and their ability to retain the agent. So again, building a strong front line is critical to overall organization growth, and you want to aim to reduce attrition as much as possible, as that's going to be one of your biggest obstacles to growth over the long run, and you can see why that is now. So now that we know how our front line is going to grow over time, we need to look at how the following tiers below that are going to grow, again, from those agents in our tier 1 going out and attracting their tier 1, which is your tier 2. So when we take a look at this, in year 1, we managed to get 14 agents in our tier 2, and that was a function of 20% of the agents in our tier 1 going out and attracting a certain number. Now, when we get to year 2, we've got 20 agents in our front line, and so 20% of them, or 4 agents, they're going to go out and they're each going to attract 5 new agent partners. And so that's going to give us 20 new agent partners into our tier 2. We started with 14, we added 20, but we have to remember 20% of the 14 left. They're gone. So we had a net of 17 agents that we added. And so we started with 14, we end with 31, and that's how this works all the way down. I haven't changed any of the math. It's the same on every single tier. 20% are going to attract. They're going to attract a certain number. That number is going to get lower each year, and then 20% from the year before are going to leave. That's how we built this model. I think it's pretty realistic. So this is what the total agent count looks like at the end of 10 years. So at the end of year 1, we had 89 agents. At the end of year 10, we had 1,615. Now that's crazy when you look at it, because your tier 1 only grew from 12 to 29 agents. Because remember, you added 70, but you lost 41 due to attrition. And so the cool thing with how these organizations work, though, is it keeps building on top of each other. So the agents that you attract, they go out, they attract agents, those agents attract agents, and it continues to grow and grow. And this is the impact long-term of being consistent at a single company and growing an organization continuously over time. One thing I want to point out, this is only 5 tiers. So this chart only applies to Real and Epique. And so they are 5-tier systems. So this is what you would expect to have based on these numbers at either of those 2 brokerages. But what happens when we look at a 7-tier model? How much does it change? So let's take a look. Again, this is our 5-tier. When we add in tier 6 and 7, this is what happens. So the dark green here are the additional agents that were added to your organization, not by any extra work that you did, but simply by how the Rev Share organization is structured. So again, your primary focus is on building your tier 1. Tier 1 is responsible for building tier 2, and so on and so forth. And so this is not, again, additional work that you're doing to get these agents. This is a function of the structure of the organization. So when you add tier 6 and 7 in year 1, you go from 89 agents to 155. In year 10, With 5 tiers, you have 1,615 versus 6,174. So again, the rate of growth stayed exactly the same. Nothing changed other than how many levels were unlocked for you based on the structure of the program. All right, so when we look at that percentage-wise, again, in year 1 with the additional tier 6 and 7, you got 66 additional agents, which was 174% of the agents you would have had without it. And by year 10, you had an additional 4,559 agents in your downline, an additional 4,500 agents, which was 382% more agents in a 7-tier versus a 5-tier system. So again, both of these, the number of frontline agents added were exactly the same. The only difference was adding those bottom 2 layers. So the difference between a 5-tier system and a 7-tier system, while it looks substantial right now, what we're going to learn is the biggest impact comes in those later years. The difference early on is not as substantial, but as we get later in time, eventually we're going to see how that makes a big difference. All right, so now let's look at some sample Rev Share earning dollars based on these numbers. Now, one of the things we need to understand is not every agent is going to cap. So when you look at these Rev Share charts, it's showing you how much you could make if an agent fully caps. Because once an agent has capped, no more money, no more revenue goes to the brokerage. Therefore, there's no more revenue to share. And so as soon as the revenue to the brokerage stops after an agent caps, revenue share stops as well. But a lot of the calculators that I've seen assume that every agent that's in your downline is going to cap. That simply does not happen. Some agents in your downline are going to sell absolutely nothing. Okay. Maybe they're just hanging their license there. They're brand new. They're getting started. They've taken a break for whatever reason. They're not going to sell anything. And then the rest of the agents are going to sell some part of their cap, and others are going to sell more. So what we're going to look at here is what's the average amount that you should actually be expecting to make per agent. And so here's what I did. Again, for the sake of being realistic and also consistent across the board, here's the assumption I've made. 25% of the agents in your downline will hit their cap, okay? And that's going to give you 25% of the potential rev share. 25% of the agents in your downline are going to hit half of their cap. So they're going to sell half the amount of real estate that would be required to cap. 25% of them are going to sell a quarter of that, and 25% are going to sell zero. So that's the breakdown that I've got. When you add all that up, what you realize is that you're actually going to be getting probably around 43.75% of the rev share that you see on these charts per agent. So when we take a look at what that looks like, this is the max revenue share at each of the individual companies that you can earn. And so again, they're all very different in terms of how they're structured. Some pay more up front, some pay more on the bottom. One of the things I do want to point out is that, as you can see here, LPT has 2 different columns because some agents are going to be on the 80-20 split. Some are going to be on the $500 flat fee, and the amount of rev share that you get per each is going to vary based on which comp plan they're on. So I needed to come up with a combined average. So what I did is I'm assuming that 30% of the agents are going to be on the 80-20, which is about right. You got 20% of the agents trying to attract, and then another 10% that are on that comp plan for other reasons that we talked about earlier. And then 70% of the agents are going to be on that flat fee, lower comp plan, the $500 per file, $5,000 cap model. So when I add all of that up, we're going to times everything by 43.75%. And this is the average rev share per agent that, based on our model, you can expect to actually receive. And so this is a more realistic number than what you're seeing with the max rev share per agent. All right, so now that we have these numbers, we have how many agents we could potentially attract into the organization, because we know that we have decreasing growth over time, we have attrition over time, but we've accounted for that, and we've got a realistic model of how many agents we could attract in our organization. We also have the average amount of revenue per agent per tier that we can expect to earn at each of these brokerages. So now we can combine these and look at realistically how much could you make at each of these brokerages if you had that number of agents and you were earning that amount of rev share. So let's start with EXP. Total 10-year earnings at EXP were $5.64 million based on this model. That's pretty good. First year, $34,000. Last year, $1.1 million, but a grand total of $5.6 million. We go to Real. Surprisingly enough, $5.6 million. They start the first year a little bit higher at 41. By the last year, they're a little bit lower at $973,000. That's a function of not having more than 5 tiers. That's why what you would see if you went out more years is that EXP would probably start to pull ahead a little bit more just based on the additional agents from the lower tiers. We go to Epique, 5.7. All right. More in the first year, less in the last year than EXP. And we go to LPT, 6.6 million. So again, a fair amount less in the first year, but substantially more in the later years. And that again is a function of the additional tiers. We had enough frontline qualifying agents to unlock all 7 levels. And when you've got those 7 levels in the later years, the organization really starts to explode. That being said, the first 3 brokerages that we looked at were shockingly close from what I was expecting. If you take the median, they were all only off by about $60,000 plus or minus across 10 years at these brokerages. For models that look as different as they are in terms of what percentage, number of qualifiers, percentages per tier, all of that, it was shocking for me that at the end, you're talking about a difference of plus or minus 60 grand across all 3 of them, given these assumptions. Now, LPT being $1 million more, I don't know if I was honestly expecting that either. And that really is a function of having a 7-tier system with a lower number of frontline qualifiers that allows you to access more agents sooner. So that's where these numbers come from. If you look at LPT, what you are going to notice is that in the early years, particularly years 1 and year 2, your earnings are definitely going to be less. And that's a function of LPT taking less money from the agents. And therefore, there's just simply not as much money to give back to the agents because LPT didn't take that much money from the agents to begin with. But because of those 7 tiers and because of the lower number of frontline qualifiers, in the later years, it really starts to grow very fast. So that's the numbers, guys. When you look at it on a chart here, even with that extra $1 million at LPT, these are all pretty similar. I mean, again, you're talking plus or minus 60 grand on 3 of them, plus $1 million on the other. It's still not that crazy different. When we look by year, and this is an interesting chart as well. So this is going to show the growth per year per brokerage. So as you can see, first year, Epique's got the most, LPT's got the least, and then things start to get kind of balanced out by a year 4, 5. And then that's where you really start to see EXP and LPT both start to kind of overtake Real and Epique. And that's a function, again, of a 7-tier system versus a 5-tier system. In the long run, the more tiers will almost always yield more income farther on down the road. But this is what you're looking at when you compare Rev Share year by year, brokerage by brokerage. So with all that information, I think we're finally at the point where we can announce the winner. And the winner is nobody. That's my opinion, guys. Nobody. Because in order to determine who the winner is, we have to figure out who's best. But best according to what? Most revenue in year 1, most revenue in year 10, revenue per agent, number of tiers, number of frontline qualifiers, fastest growth. Like, how are we going to judge these rev share organizations that all look very different, but all pretty much kind of get you to the same place after a long enough period of time? How are we going to determine which one's best? And I don't really think we can, because for me to determine what's best, I need to know what's most important to you. And I don't know right now what's most important to you in your goals in building a rev share organization. So I really can't answer which one's best. But what I do want to do is take a look back at the 3 sides of the revenue share and go to our last little side here, which is growth potential. So everything that we've done up until now is theoretical. These are the theoretical numbers given these assumptions that you could get. But what we have to make sure of is, does the brokerage that we're aligned with have the potential in themselves to allow us to grow our organization large enough to actually capture those dollars? So let's take a look at that. Again, revenue share is where a brokerage shares its earnings with agents for helping them to grow. So you have to have 2 things in order to earn rev share. You have to have growth and you have to have earnings from that growth. So if you don't have any growth, there is no earnings from the growth that you're generating, which means there is no new revenue to share with you. And so what that means is that if you already have a rev share organization at any one of these brokerages today that's doing well, it will likely continue to do well and continue to do better over time, most likely. However, if you're looking to join one of these brokerages and start a rev share organization, which is probably why you're watching this video, this is a much more crucial question to ask, which is the brokerage growing? Statistically, you cannot build a growing rev share organization that is at a brokerage that is not growing. If the brokerage isn't growing, your Rev Share organization is not growing because you are just one little sliver of that entire organization. All right, so now we want to look at the total agent count that each of these brokerages has as of May of 2024. We'll start with Epique. I'm not going to include them in many of the calculations moving forward just because it's hard to find up-to-date, accurate information about them. I know they're over 1,000 agents. They may be 2,000 agents by now. I'm honestly not sure. They've been in business for about 3 years. LPT, we're sitting at 11,000 agents after being in business for 2 years. Real Broker is at 16,680 agents after 10 years, and EXP is at 85,780 agents after 15 years in business. So these are the total agent counts, just to give you a perspective of how big each of these brokerages currently is. If we look over the last 3 years, though, this is very important, and this is what is crucial to the Rev Share side, which is growth. Total number of agents, unless you're already at the organization and already have a large Rev Share organization underneath of you, is very irrelevant. What matters is you're trying to build an organization is how much are you growing. So as we look at EXP Real and LPT, you can see the difference in how they're growing. LPT seeing a lot of growth, Real seeing a lot of growth, and EXP, what we're actually seeing is a decreasing growth. So they're actually shrinking right now. So when we look at those numbers as percentage growth since 2022, because again, LPT Realty has only been around since 2022, so that's as far as I can go back to keep this fair. In the year 2022 to 2023, LPT Realty grew by 900%, Real by 122%, and EXP by 1.76%. And then from 2023 to 2024, LPT Realty grew by 175%, Real Broker by about 67%, and EXP shrunk by 2%. So what that means is that EXP Realty had more agents at the beginning of 2023 than they did in 2024. So they're now losing more agents than they're gaining. Again, it doesn't mean they're not gaining agents. What it means is they're losing more agents than they're gaining. LPT Realty is losing agents. Real Broker is losing agents, but they're gaining substantially more than what they're losing. And that's where that 20% attrition number that we factored in needs to be adjusted kind of on a case-by-case basis sometimes based on the organization that you're in. So if you're at EXP, that attrition number needs to be way, way higher to be realistic with what they're actually seeing right now. And here's the breaking news, guys. Rev Share opportunity diminishes over time. I don't know why no one just comes out and says this, but that is the absolute truth. Every single one of the organizations that we looked at today, over time, the opportunity to join that brokerage and build a large Rev Share organization will continue to go down. Well, why is that? Not everything grows up and to the right forever. Now, there's some Bitcoin investors out there who are probably going to argue with me about that, but I will tell you, nothing grows up and to the right forever. And most real estate brokerages over time hit something called their saturation limit, their saturation level, where the number of agents that are going to join that brokerage pretty much caps out. And then they either grow just a little bit, shrink just a little bit, but they kind of stay right in that range. When that happens, the opportunity to join that brokerage and build a large Rev Share organization goes to zero. It doesn't go low, it goes to zero. You can't build a large Rev Share organization at an organization that isn't growing. If you're already there and you already have a Rev Share organization, you can maintain it and sustain it for a while. Some agents are going to leave, some new agents will come on. But in terms of building a Rev Share organization at a company that is not growing, it is not possible. I stand behind that, and anyone who feels differently is welcome to tell me why they feel differently, but that's what I have seen. And so what I know is 15 years from now, if I'm doing a video about LPT Realty telling you reasons to join, one of the reasons I will not be telling you to join is for Rev Share, because by then, the potential here will be diminished as well. In 15 years, we'll probably be coming up on what our saturation level is, the same way that EXP is doing it right now. The same thing will happen to Real, the same thing will happen to Epique, the same thing will happen at each one of these organizations. Rev Share is an opportunity for people who get in early to help that company grow. The more you help the company grow, the more that you can benefit from that. But if the company's not growing, you can't build a Rev Share organization. That is just the reality. Now, I want to go back. This was last year's numbers, and just for comparison, again, at EXP Realty versus LPT Realty, when you looked at how many agents each company had that was actively attracting and how many agents they brought in, on average, an EXP agent would have gained 0.5 partners in the entire year, and an LPT agent would have gained 16 partners in the entire year, meaning that an LPT agent was 32 times more likely to attract an agent than an EXP agent was. Does that mean that LPT Realty is 32 times better than EXP? Not necessarily. It just means that the rev share opportunity has diminished to a point where it's really just not feasible anymore. If I ran these numbers, given what we just saw, we would actually see that every single agent on average would have lost a portion of an agent, probably about a quarter of an agent per recruiting agent at EXP. On average, everyone's rev share organization shrunk last year at EXP, statistically speaking. And to show you what that looks like visually, this would have been the net agent change at each of the brokerages since 2022. So again, at the same time that EXP had gained 1,515 agents, LPT gained 3,600. And at the same time that LPT gained 7,000, EXP lost 1,735. That's how the numbers shake out. But here's the cool thing. 80% of the agents in your downline organization don't care about any of this at all. Why is that? Because 80% of the agents are not going to do anything with rev share when they're at most of these organizations. We know that because we have 15 years of data to show it. And so with that being said, what's the value proposition for the brokerage when rev share potential is gone? If the value proposition that you have is based on rev share and the rev share is no longer possible, what's the value proposition? And so what I would suggest is, as you're exploring brokerages, and what we've already established, at least in my opinion, is there is no clear winner when it comes to rev share. What I do think is that each one of these brokerages has thoughtfully put together a plan that they think will effectively reward the agents that are helping them grow their brokerage. And based on what I've seen, each one of them has done that successfully in some form or fashion. Is it going to be a lot more attainable at certain brokerages than others? Absolutely. But they've all made it possible, mathematically speaking, to grow a large rev share organization at any of them. But when that potential diminishes, what's left over? So for the 80% of agents with no downline, this is my pitch for why I think LPT wins out over the others. Dollars and cents wise, this is how it adds up to me. So for the 80% of agents with no downline, over the same 10 years we just looked at while the individuals were building their downline, the 80% of people who didn't have one, this is what they could be experiencing. $110,000 in additional splits at EXP versus LPT. So the same agent who didn't do any agent attraction at EXP and didn't do any agent attraction at LPT, they would have saved $110,000 in annual splits by joining LPT instead of EXP. At both Epique and Real, an agent would save $70,000 over that exact same period of time. Now, the cool thing is if you join LPT, you take that $5,000 cap, maybe eventually you realize you do want to get into agent attraction. You happen to, bring on a big team. You've got an organization that's starting to grow. You're not stuck at that low flat fee comp plan. You can switch to the rev share brokerage partner comp plan and start earning all those revenue share dollars. But you're not having to pay the higher cap while you're doing it. So you can build the downline, and when it gets big enough that it makes sense for you to make the switch and take on that higher cap, we give you the option to do that very, very easily. So at the end of the day, all of this really comes down to one question. What are your goals? What are you trying to accomplish? What's important to you about your business, about a brokerage that has a rev share option? Again, I think what we've learned is that it's not easy to name a winner. And I think a lot of people were probably expecting me to name a winner at the end of this, and I just don't see one because I don't know what your goals are to know what's best for you. If your goal is to join a brokerage, not be there for very long, you're going to stay for a year, you want to make as much money as you possibly can in the first year, there's options for that. If you want to stay somewhere for a long period of time and really have a career and really build a large organization and make the most amount possible in the long run, we have options for that and everything else in the middle. But you have to ask yourself, what are your goals? What are you trying to accomplish? And I just want to think, again, I want you to think about the question of what's the value proposition left when the rev share potential is gone? Because the rev share potential at each of these brokerages over time will be gone. So ask yourself, which brokerages provides the most value if rev share didn't even exist? So that to me is the approach that I took, and I found personally LPT Realty happened to be the brokerage model for me. Again, my personal goals are I don't really care initially in the first couple of years whether I'm making the most or the least or a middle amount. But what I plan to do is over time continue to stay consistent, build my organization, and hopefully in the long run have, again, a very large, very successful rev share organization that can offset a lot of expenses for me, for my family, and allow me to stop trading as much time for money. If you have similar goals, great. This might be a good model. Either way, I would love to connect with you. I'd love to learn more about your business, what it is you're trying to do, what your goals are to see which brokerage might be the best fit. It might be LPT Realty, it might be someone else, but I would love to connect with you, get a chance to know more about you, your goals, your business, what you're hoping to accomplish, answer any questions that you've got, and see if this might be the right model for you and if I might be the right sponsor. If you're interested in doing that, click the link down in the description below. You can schedule a private one-on-one Zoom call with me. I would love to connect with you, learn more about you, and we'll go from there. Guys, thank you so much for watching. If you've got questions, leave them down in the comments below. I will do my best to get all of them answered. And until then, be well.